Volatility is a measure of how much an asset's price changes over time. In this video, we will look at 3 different types of volatility, and after that I will present 5 surprising facts about volatility that you didn't know. But before we dive into the video, don't forget to subscribe, like and share. The most common thing to look at is historical volatility. Historical volatility refers to the fluctuations in an asset's price over a specific period of time in the past. By analyzing historical data, you can gain insights into a cryptocurrency's past performance and gauge its risk level. But there's also something that is called volatility on equity. So how much is the money you have, for example, on your Binance account going up or down? What we do with TYSON is reducing volatility of equity as much as possible by having those very tight stop losses. If you want to know more about TYSON, click the link below in the pinned comments before continuing this video. The next thing I want to talk about is implied volatility. Implied volatility is derived from options trading and reflects the market's expectations of future price fluctuations. Higher implied volatility suggests that traders anticipate larger price swings, whereas lower implied volatility indicates more stability. Monitoring implied volatility can help you gauge market sentiment and make more informed decisions. Then we have realized volatility. Realized volatility is the actual price fluctuation that occurs within a specific time frame. It's a real-time measure that can help you identify current market conditions and adjust your trading strategies accordingly. Keep an eye on the news, social media and other influencers to stay up to date with the latest market trends. Now, before I tell you 5 surprising facts about volatility, please take 2 seconds out of your time and show us that you appreciate this free content. It takes a lot of work to make these videos, and we really appreciate if we can bring the channel to 1,200 subscribers until the next week. That would be amazing. So now I give you 2 seconds. Did you subscribe? Very nice. Let's move on. So let's jump into some alpha here. The first interesting fact is mean reversion. Volatility, like also price, is mean reverting. This means that when volatility is significantly higher or lower than the historical average, it's likely to eventually return to the average. This characteristic makes volatility a popular target for various trading strategies, such as those involving options. The second fact I have for you is that volatility tends to cluster, meaning that periods of high volatility are often followed by more high volatility, and periods of low volatility are followed by more low volatility. This phenomenon can be observed across various asset classes and timeframes, allowing traders to anticipate potential market moves and adjust their strategies accordingly. I hope you're still with me. I know volatility can be a little bit intimidating at the moment. It's quite complicated. If you have any questions, just leave them down in the comments. And also, if you're interested in a video about advanced topics like Parkinson or German class volatility, also drop that in the questions and we're going to make another video. But now we're going to continue with another interesting fact about volatility. It's typical for volatility that it increases when an asset price falls. This is because market participants often become more fearful and uncertain during downtrends, leading to larger price swings. As a result for that, volatility can serve as a useful indicator of market sentiment and potential trend reversals. Number 4, volatility is not just about downside risk. Contrary to popular belief, volatility isn't just about downside risk. It actually measures the magnitude of price movements in either direction, both up and down. In other words, high volatility could signal both large price gains and large price losses, making it an essential consideration for risk management and trading strategies. And the last one I got for you today is implied volatility versus historical volatility. So while historical volatility measures the actual price fluctuations of an asset over a specific period, implied volatility is derived from options prices and represents the market's expectation of future volatility. By comparing those two, traders can gain valuable insights into market sentiment and potential trading opportunities. So those were our 5 insights on volatility. Thank you so much for watching. One last favor again, share this video, like and subscribe to the channel. This keeps us motivated. Thanks for watching.